Hi, it's Nick Ryland with Vantage Point Financial. Hope you're doing well. Just wanted to take a few minutes to talk about the recent stock market volatility. Today is February 1st, and so we have the first month of the year in the books, and we've seen a lot of major swings in the stock market. At the end of yesterday, the Dow finished down 3.5% for the month. The S&P was down 5.5%, and the NASDAQ index was down 9.5%. So those are some pretty big swings in only 1 month. And I want to talk to you today about what's going on out there and hopefully add context to what's happening and alleviate some fears that you may be having. So a few things that we're looking at in terms of what might be causing all this volatility. The first thing that really jumps out is, the COVID pandemic that we've been dealing with now for, it's hard to believe, 2 years. That's causing a lot of volatility for a variety of reasons. But when you really look at the roots of everything, we can kind of narrow it down to three main things that are on the docket right now. And the first one is inflation. So we're at 40-year highs in inflation. We haven't seen inflation like this, obviously, since the Jimmy Carter era in the late 70s and early 80s, where we saw double-digit inflation. Right now, we're tracking at about 7 to 8% annualized, and that's by far the highest we've seen in quite some time. The last uptick in inflation was in 2008, where I think we bumped up on 5 to 6% for a short period of time. The good news is that we've been in a really low inflation environment for the last 10, 12 years, averaging 2% or less. And so when we factor in what's happened more recently, if we take a longer term average, we're more in line with that 3% historical average that we've kind of seen over the last 100 years. Not that that helps anyone feel good about what's going on out there, because we're seeing food prices go up, gas prices, furniture, cars, you name it, everything's costing more. And there are a variety of reasons. I mentioned the pandemic. Part of that is that we have a lot of government spending, that they're putting a ton of liquidity out there and money in the market for businesses, for individuals, there's stimulus plans, for packages. So there's a lot of money out there, but there's too few goods. Too much money chasing too few goods, because we've had supply chain issues with several industries that were locked down for several months at a time, causing a big disruption. And so we just can't get enough of the goods and services out there to meet the high demand. Hopefully that starts to loosen up. But this inflation causes uncertainty. No one likes to pay more at the pump or at the grocery store, that's for sure. So the Federal Reserve has some things in their toolbox that they can do to help fight the inflation. Generally, it's raising interest rates. So they've already talked about raising rates this year. They expect the first one to come in March at 1/4 point. And their goal is to do 4 increases by the end of the calendar year 2022. We'll see if that happens, but I think they're talking a 1/4 point each time. So that's only a 1% increase. So it's not drastic, but hopefully that'll help stem some of this inflation. And then we have the Russian-Ukraine conflict. We could have a war there, and the U.S. could be involved. So we'll see how that plays out. But from an inflation standpoint, Russia supplies about 35% of the oil and gas to Europe, and so that would take a hit. Ukraine is one of the top exporters of wheat and corn in the world. So we could have an increase in food prices, even higher than what we're seeing now. We could also have another increase in oil and natural gas prices. So we'll see how that plays out. But bottom line, all this uncertainty and the things we're talking about cause volatility in the stock market, which causes our stomachs to turn. None of us like to see volatility and uncertainty. So what we always fall back on is our bucket plan. For those of you that are current clients, you should have a bucket plan and know that we're constantly watching it to make sure that it fits your situation and the current market. If you don't currently have a bucket plan and you're not a client of ours, I highly encourage you to look at something like this. We believe everyone should have 3 buckets of money: a now, soon, and later bucket. A now bucket for safe and liquid money, the income you need to live on, emergency funds, if the car breaks down, the roof leaks, and any upcoming planned expenses. You want to park that money in bank accounts like checking, savings, maybe a money market account, or high yield savings from some of these big banks out there. It's a misnomer. They're not really high yield, but they're higher than your local bank typically. You can get about 0.5% on that. But it's not about the return. It's about the safety and the liquidity. Then we look at the soon bucket. This is the money you'll need over the next 2 to 10 years. This should be still conservatively invested. We want to take little or no risk here, but we want to get a little better return than we're getting in the now bucket. The key here is that if you're retired, this is your first or your next 10 years of income, and you don't want much risk there. You want to make sure that that money comes in like clockwork, like a paycheck, regardless of what's happening in the stock market. If you're within 10 years of retirement, I highly encourage you to start building that soon bucket. Markets are still pretty high relative to the all-time high numbers that we saw just a few months ago. So it could be a good time to start piecing off some high-risk assets and filling out your soon bucket. But once you have the now and soon buckets taken care of, you've bought yourself a 10-year time horizon with little or no risk. And then every other dollar can be invested in the later bucket for long-term growth. Now, the long-term growth bucket, you're going to have volatility. But psychologically, it helps you to know that that's money that you're not going to touch for 10 years or more. And you can stick to the plan, you can stay disciplined and ride it out. The stock market always comes back. We don't know how long it will take. We don't know how severe the downturn could get. But we've seen very short rebounds like in 2020. We've seen longer rebounds that might take 2 to 4 years. So 10 years gives us plenty of time for that money to come back and start growing again for us. So the key here is having a plan. And we find the people that are the most unnerved by inflation or volatility in the stock market are those that don't have a plan. And in its most basic form, the bucket plan helps alleviate those fears. So if you have any questions on this, please reach out to us. If you have family or friends that are scared or don't have a plan and they need someone to talk to, by all means, we'll see if we can help, whether they have a couple questions or they really need a full-blown financial plan. We're absolutely here to help. So thank you and appreciate your time today.